the velocity of money. And just like we understand velocity is traveling in a direction as a function of time, that is what velocity means. It means speed as a function of time, in a direction as a function of time. Now, money must keep moving. What we call money, and this, I'm talking about money in the form of a currency. If you have money in the form of a currency, then you need movement, meaning you must keep your money going, because every time money is stationary, it declines in value. Money declines in value, or currency declines in value if you hold on to it. If it's not invested, if it's not moving, it declines in value. And to keep the money moving, we talk about the velocity of money. Every country out there requires a high velocity of the money in the economy. The money has to keep circulating and moving, otherwise the country starts to shrink. In business, we call that cash flow. Cash has to be moving. You need cash flowing because that is the lifeblood of every business, but it's also the lifeblood of every country. Now, if it's really that important for a company and a country, then in your financial life, it's also very important. And so what I want to talk about is really something we call the velocity of money. And this deals with how quickly your money moves. How quickly your money moves. I'm going to talk about 4 different asset types, but I'm going to focus on one. Business, commodities, paper assets. And by paper assets, I'm talking about stocks, bonds, mutual funds, etc. And number 4, real estate, or what people call property. Let's assume you have £200,000 as your investment, equity investment, as an example. We'll use that as a basis for this discussion. If you had 200,000 as your equity investment, and we were to begin with business as an option, one of the things you find out very quickly is that if you have a business and you have 200,000 pounds as equity, very few banks will lend you or loan you more money for a business, except as a franchise or except your business plan is very robust. You have to show the due diligence, you have to show the track record of you having sound financial education. You have to demonstrate that the risk of the bank losing their money is very slim. You've got to provide an understanding for them to see clearly that it's safe, it's secure, there'll be a good return on the investment. You've got to demonstrate a few other things such as appreciation and growth of the business before the bank loans you. So if you had £200,000 in most cases, the bank might maybe give you a loan, maybe something little, but in most cases, if you invest 200,000 in a business, for this business to grow, after you put in 200,000 pounds, you cannot take out the 200,000 pounds. Because if you take out the 200,000 pounds from the business crumbles. Every business requires reinvesting. You generate profit, you reinvest in the business, the original capital and the profit, you reinvest, and it continues up to the point whereby the business starts to create a level of wealth. Now you can pull out some money, but originally, for the first few years of starting a business, you cannot pull out the money, meaning that the velocity path in a business is very slow. You put the money in there, it has to sit there for a long time. In some cases, it might be there for 10 years. In some cases, if you're very lucky, if you're successful, you might be able to get to a point where in 7 years, you're doing really well, and maybe you can now pull out this original equity. With stocks, bonds, mutual funds, what we call paper assets, if you invest £200,000 and you buy £200,000 worth of stock, even if the stock were to increase by 10% in value, to be able to make the best and benefit from this increase in value, the only way you can do that is you have to sell some of your stock. As a matter of fact, let's assume that you bought 200 shares with 200,000, and let's assume there's been a 10% increase in value. If you choose to put out the 200, let's just assume this has now become 220. To pull out the £200,000 originally, you have to sell 200 stocks, meaning you only have 20 stocks left, or shares rather left. So you see that even with paper assets, your velocity is weak. You have to either sell a portion of what you have to get the money back, meaning it's really difficult. Now, if we move quickly to the next, which is commodities, gold, oil, silver, you have to do the same thing. You put 200,000 and you acquire gold. Yes, that gold may have appreciated in value, but to get your money back out, you have to then go back and sell some of the gold, meaning that you can't have your cake and eat it. But with real estate and property investment, everything changes. Everything changes. Because it's the only investment path and opportunity whereby you can go back. Let's just assume, for example, now think about this. I have £200,000. I want to invest in real estate. I go in, the bank offers to give me £800,000. I buy a property for £1 million. The property increases by, let's just say, 10% in value. After the first 2 years, I can go back to the bank and refinance using debt leverage. I can pull out £200,000 from the investment, tax free. I can still maintain ownership of this property because it's going to buy 10%. Now, the reason it's going to buy 10% is this. 10% increase by 1 million means you have now 1,100,000. The bank would always normally give you about 75% of the new value minus the loan. So here you had 110 less 800,000. The bank will be willing to give you 75% of that value. So 75% of 300,000. Now, if you're good in negotiating and you're good at talking, you can get even more than that, providing you can demonstrate to the bank that by refinancing, you're still making a profit by having the increase in value transferred to increase in rent, increase in income, reduction in expenses, so that your tenants perhaps cover the cost. So with real estate investing, you can pull out the original investment seed. We'll call it seed. You can pull out the original investment seed and you can still retain the entire investment. What this allows you to do is take that seed capital, move it very quickly, go back to the bank, buy another one for £1 million. Which means the velocity of your money is moving. After 2 years, you can do this. Now, don't get mixed up. Don't get it confused. Depending on the mortgage or loan term you agree with the bank, in many cases, it would take about 24 months or more before you can pull out or refinance. Very few banks are going to refinance in 1 year. They will normally lock you in 2, 3, 4, 5 years before you can pull the money out. Because what you're dealing with is appreciation and you're dealing with growth. The money doesn't just multiply. What you're doing is going back to the bank and saying, the value of the property has gone up, and so I can pull out the money. Just like in any investment, the value goes up, but with real estate, the bank allows you to pull out the money. But interestingly, because what you're pulling out now think about this with a business. If you pull out £200,000, that is income. So you must pay taxes. If you're a business, let's assume you pay 20% tax on 200,000, you'll be left with 160,000. If you were dealing with gold and you're dealing with commodities, the same thing applies. It's income, meaning you have to pay taxes. In this case, let's assume it's 20%. You take £160,000. With paper assets, bonds and stocks, the same thing applies. It's income created. If it's going to buy 10% in value and you're pulling it out, you have to pay tax. But with real estate, it's debt. It's debt, meaning you don't pay any taxes on debt. So you pull out this money tax free. You move it to another investment. You hold the second investment for another 2-3 years. If it appreciates in value enough, you pull out the original equity you had originally. You move it to another investment. Now what happens here is this. Just imagine that you did this for 3 different investments. The first was for $1 million. The second was for $1 million. The third was for $1 million. In 3 years, you now have an investment portfolio of about $3 million. Doesn't mean you have equity that much. You just have an investment portfolio. That in itself is how wealth is created, and it's achieved by having your money moving. I usually say put your money on some roller skates and let it move. Let it move. The faster it moves, the better for you. The faster you can get your money moving, the more financially intelligent you are and the wealthier you become. I hope that's been useful. God bless.